But one thing this debt ceiling issue is doing is focusing the market's attention and the investment community at large attention and just how dire the situation is. I mean, we need to raise trillions of dollars between now and year end. I don't think there's going to be enough buyers out there, at least not at these interest rates.
On Wednesday, the Federal Reserve raised the Fed funds rate for the 10th consecutive time by 25 basis points.
Today, our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change.
A move that was already widely anticipated by market participants. But what is the next move by the Federal Reserve? Are they done raising interest rates, or are there more to go? And what is the long-term impact on asset prices of raising interest rates by 500 basis points consecutively for more than a year? Joining us to discuss this is David Hay, Co-CIO of Evergreen Gavekal, a diversified fund with $4 billion in assets under management. David, it's good to see you again. Welcome back to the David Lynn Report.
It's a privilege. It's David Squared once again.
Yeah, the David Squared Show, always fun. Let's talk about what happened today first, and then we'll discuss your outlook. So, as we're speaking right now at 3 p.m., as of 3 p.m. Eastern Time, the stock markets have been largely unchanged since the release of the Fed statement, and now the Jerome Powell's press conference is still ongoing. What are the key highlights that you took away from Powell's press conference?
Yep. And when you said market reaction, one of the interesting market reactions is the futures market, where it's now pricing in an 88% probability of another hike in June. And that's a big jump. So it's a little surprising that the stock market's taking this as well as it is, although it's been weak lately, particularly in the banking area. But as far as his comments, I thought what was a very valid point that he made is that listen, we've raised interest rates drastically, 500 basis points, which in English means 5%, in a little over a year, and yet the unemployment rate is still 3.5%. It's still at a very low level, and you've still got 1.6 million roughly of job openings, though I would question how accurate that number is. I think there's been some double and triple counting, but regardless, it's still, in his words, and I think in reality, a very robust jobs market. So the Fed's been able to tighten like crazy. And as he pointed out, they've brought inflation down. Now, the problem is inflation is, we talked about last time, and as I've been writing and chatting with other people, inflation's turning out pretty sticky. So they're having a hard time getting some of these, their favorite inflation measures to come down to that, dream 2%. They're having a hard time getting it below 5%. So if you use the current inflation rate and a Fed funds rate that's just about 5%, it's really a zero real return. Now, he got into that in his comments and saying, look, we've got to assume that inflation is going to come down to 3% in the relatively near future. I think he's using inflation expectations, and therefore the real Fed funds rate is 2%, which is fairly restrictive. So it really depends. But boy, you look at Europe, and they're having a hard time getting inflation down too. It's running at 7% in inflation. The inflation rate is in Europe overall. It's 10% in the UK. So these central bankers have let the genie out of the inflation genie out of the bottle, and they're having a really hard time getting it back in.
And you know who else was having a hard time? The middle class of America, because they were the ones suffering throughout this inflationary episode. Now, Jerome Powell did say that going forward, he expects the inflation fight to continue, and he expects that to fight inflation, I'm paraphrasing, but to fight inflation, the labor market may suffer somewhat or slow down, I believe were his words. But at the same time, he was commenting on the Fed staff's projections of a mild recession later this year.
Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants.
So how do you reconcile the supposed juxtaposition between slowing labor market is what he's projecting, but also no recession?
Well, I think he's being excessively optimistic. And let's face it, the Fed's economic forecasting record is atrocious. And his, since he's been in place, has not been that great either. So I wouldn't put a whole lot of credence in that. I think it's a little disturbing that the Fed itself, the people like Jay Powell and the other governors, are ignoring their own staff forecasts. And it was interesting where he got a little bit flustered today in the parts that I watched, and I cut off so we could have our discussion. But Steve Leisman from CNBC was putting him on the spot about the staff reports on Silicon Valley Bank when it was clearly having problems in its investment portfolio. Way too much duration and big unrealized losses on the investment portfolio. And
the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
And he basically kind of blew that off and said, "Oh well, they were on the case." I basically kind of doing the Pontius Pilate, washing his hands, saying I didn't need to do anything because they said they were on the case. But it's pretty embarrassing. Really, when you see the fact that we've now had a greater amount of assets go down in terms of bank failures so far already than we did in 2008, 2009. That's a little bit smaller percentage of GDP, but we've still had 3 major bank failures in a relatively short period of time. And yet the Fed was just oblivious to this happening. And if you look at the way these regional banks are trading, surviving ones, it's not encouraging. It looks, if you believe what the market is saying, there's going to be more of these shotgun marriages coming up. Now, maybe it won't be a total wipeout for bondholders, preferred stockholders, and common stockholders as it been with First Republic, but I don't think this is behind us totally, David, by any means.
Just last night, PacWest, Western Alliance, and other regional bank stocks continued to crash. They led the charge downward for the regional bank stocks index. And so when you say that this is not over by any means, do you mean that you are expecting more either bank failures or more consolidation?
Yes and yes. Now, it could be that they'll consolidate before they actually fail. This was these last 3, the Silicon Valley Bank, the Signature Bank, and now First Republic. Those are, complete wipeouts to equity and bond holders, which, that's what we avoided after the initial, the Washington Mutual and Lehman failures back in 2008, 2009. So these guys were, these were very extreme outcomes. Now, maybe going forward, we'll see a nominal amount paid to the equity shareholders. Maybe the bondholders get made whole. I hope so, because I think if you continue to have these kind of wipeouts, if you're a bank investor, you're going, do I really want to take a risk? Yeah, I think it's going to get worse. I do. And I think there will lead to more consolidation. We've still got something like 5,000 banks in this country. Most other countries have just a few hundred. And if you go back to the 1960s, we used to have 24,000 banks in this country. And so not easy to regulate when you got that many banks. And so that's the trend, and I think that trend is going to continue.
If you look at JP Morgan stock, for example, it's been up tremendously over the course of April, and just on May 1st, it went down after the announcement of First Republic Bank consolidation and the buyout, but not by much. My question to you, David, is whether or not big banks like JP Morgan and perhaps some others are a good investment play right now, given that you're expecting more failures in the regional banks, perhaps more forced marriages, like you said?
I think Jamie Dimon got a great deal, and he knows the ropes. This isn't his first rodeo when it comes to taking over distressed banks. He did it with Bear Stearns, and then he did it with Washington Mutual. And you can tell from his comments and his body language that he's quite pleased with the way this one's turning out. He got a lot of baggage with those first 2 back in 08, 09. But this one, as he said, it's a very clean bank. And, First Republic's got a great franchise. They've got a really big wealth management division. So a lot of their wealth managers are competitors. And, they've got a big branch, physical presence. They got a lot going for them. So I think it's a great deal for Jamie. and for JP Morgan. So yes, I would think that the stock's pretty inexpensive. It's probably a good long-term buy.
Your outlook on the banking sector differed slightly from what Jamie Dimon himself said after news that JP Morgan had purchased First Republic assets. He said that the banking crisis is over, or at least this part of the banking crisis is over. There are only so many banks that were offsides this way, Dimon told analysts in a short call. There may be another smaller one, but this is pretty much resolves them all. This part of the crisis is over. Do you agree?
No, I think he's being a little politically correct there. I think that competence is such an important role to play. And as we talked about last time, the other issue is what's happening to the net interest margins for these banks, because the money is coming out of these very low interest rate deposits. So low cost for the banks, low earnings for the depositors, and going from those, say 0.5% into government securities money funds at 5%. And the reason those funds can pay that is they just lend it to the Fed, and the Fed pays them 5%. And the Fed's got something like $4.5 trillion that they're paying 5% on. That's costing taxpayers about $200 billion, by the way. So there's this massive shift of money underway. And as we discussed last time, when you combine that with money supply that's falling at the fastest rate since the 1930s, which it is, and I think you got a visual on that at some point, then velocity plunging as well because of this shift of high octane money to low octane money. So once that money goes from a bank setting into government securities, it goes from having a high multiplier effect to a low multiplier effect. So that, and I think that's going to happen to a degree that we just haven't seen before. But that flight of capital is going to continue to squeeze bank interest margins. And a lot of these banks, if you mark their loan portfolio and their investment portfolio to market, they are effectively broke. They have negative net worth. Now, it may not be as dramatic as First Republic, and there may not be the run, but I think it's really hard to predict bank runs. When the depositors get nervous and they start getting out quickly, these things can fall and implode rapidly, like almost overnight.
And so investment implications of the Fed decision today, where should we be positioned right now?
I think the best approach is to have a lot of short-term treasuries, at that 5% type of rate, or government money funds. But I also think that buying these more economically sensitive areas of the investment world, and particularly energy. I mean, energy has been absolutely crushed here recently. And as an energy bull, it's been a painful experience. I will admit that. Though I've been an energy bull for a long time, and energy was a tremendous performer in 2021 and 22, outperformed the S&P by over 100%. But it's going through a correction. But it's the problem for oil is that whenever the investment community gets negative on the economy, they short oil. And the paper market for oil, derivative market, futures market is 30 to 50 times the physical market, whereas most commodities, it's more like 5 to 6 times. So it's just the redheaded stepchild that just gets beaten up in these kinds of situations. But if you assume that ultimately the Fed is going to have to restart its magical money machine because they're going to have to be the buyer of last resort for that government debt, then I think a lot of these hard assets, which are getting hit hard right now, are going to rocket. So you got to be a little tough. But I think having this balanced approach where if you have, say, half your portfolio in very defensive securities and the other half in a mixture of high quality, blue chip stocks, good dividend payers, along with these hard asset based companies, I think that's about as good as you can do. I think emerging market debt's quite attractive right now. I think that's going to be a beneficiary. I think the mortgage REITs, the high quality mortgage REITs, because at some point the Fed is going to cut, and they're going to cut like one of those chefs at Benihana's, when they finally do start cutting. And that will, steepen the yield curve, and things that benefit from a steeper yield curve are going to be big winners. And mortgage REITs are a good example of that. But I'd avoid the ones that have a dicier loan portfolio and stay with the real kind of the plain vanilla versions.
And I know you've written a number of books about how the bubble has gotten. Bubble 2.0 was the last bubble we had. We discussed this last time. I think it was 2008 you were referring to. We're currently in the biggest bubble of our generation, of our lifetime. And can you tie that theme into what the Fed is doing right now? Do you think that a continuation of Fed funds rate above 5% perhaps may burst this bubble or make it even bigger, or exacerbate our current financial situation? What do you think is going to happen?
Well, to be clear, I think it already did. I think just the Fed shifting from what it's part of the problem for the banks is that the Fed convinced them they were going to keep interest rates at virtually zero indefinitely for years to come. So that's why these portfolios got positioned the way they did. So, back in March of 22, when the Fed made it clear that they were going to go on the warpath, that's when you saw bubble 3.0, which I consider to be the biggest bubble ever, really start to leak a lot of air. And that's when it really seriously deflated. So 2022 was definitely the year of bubble 3.0 meeting its maker. Now you could say that, and I would agree with this, that we're in a bit of an echo bubble right now with some of the tech names that the profitless tech. I'm not talking about high quality, but a lot of these very speculative names that have had a kind of a Lazarus-like revival. But I think they're going to have another down leg. And the same thing happened coming out of in bubble 1.0, which was the tech bubble of the late 90s. When that bubble burst in 2000, in 2001, there was a very powerful rally, end of 2000 and early 2001, a very powerful technology rally, and then it resumed its downtrend, which is what I think we're going to see this time. So I don't think there's any question that we hit peak insanity in 2021, and then it really started to come apart in 2022. In fact, it was the worst year for balanced portfolios since 1871. So I don't think there's any doubt that bubble 3.0 is already in a serious deflation mode.
It's funny. We were talking as we started this conversation at 3 p.m. Eastern time. The S&P was sort of flat on the day. Now it's down 0.16%. If you look at your screen, it's slid dramatically post 3 p.m. So I don't know if Powell said something after we started our conversation, or the markets just haven't fully digested the message yet. But in either case, the markets were up a little bit earlier today, and now it's down. And so my broader question is, what is your outlook for the stock markets throughout the remainder of the year, given your macro outlook and given what the Fed's about to do?
I think it's going to be a tough summer. I think the old classic saying, sell and may go away, is really appropriate this year. One of the things that you look at is, this is a market that's got serious halitosis. And by that, I mean bad breadth in terms of 90%, 95% actually of the S&P's return for the first quarter came from 10 companies, 90% from 5. It's just unbelievably narrow leadership. So that's not good. And then if you look at the equity risk premium, which basically compares the multiple, the PE on the market, or the earnings yield on the market, to the inverse of the PE, to the risk-free interest rates, it's the lowest it's been since 2007. And just as a refresher, 2007 was right before the market went down about 50%. And it's a pricey market. It's not a cheap market. It's not a market that's discounting a whole lot of negatives. And yet, guess what? We have a whole lot of negatives. Again, this federal financing thing is, we talked about last time, one of my two mega risks for this year was that there would be a federal fiscal funding fiasco, the 4F scenario. And I think a lot of people have blown that off. But one thing this debt ceiling issue is doing is focusing the market's attention and the investment community at large attention and just how dire the situation is. We need to raise trillions of dollars between now and year end. I don't think there's going to be enough buyers out there, at least not at these interest rates.
Can you elaborate on these two mega risks? So you talked about one. What's the other?
The bursting of the global housing bubble, which has been much more severe overseas, and you are seeing a lot of weakness in housing markets in Canada, in New Zealand, in Australia, and some of the Nordic countries. Sweden looks like another disaster. It's gone through it before, and some people have to renationalize their banks once again. But and it's not just housing. I throw housing out there, but I've been really negative on commercial real estate. And by the way, small banks hold about 70% of commercial real estate loans, so they're heavily exposed. Office buildings in particular has been the area that I've been most negative on. They're down 25% in price from a year ago. And there's another example of the bursting of bubble 3.0. So it's going to get pretty darn ugly. Charlie Munger, by the way.
Yeah, I was just going to say, you and Charlie Munger on the same page in this one. You beat me to the punch there. Okay, let's talk about that. That is a very big topic. Real estate is something that affects everybody. Fed's actions today and going forward certainly aren't helping, a lot of people would say. Rates need to come down, right? Or do you...
No, I think so, because they tend to be shorter-term mortgages, commercial, in some cases variable rates. So there's a lot more interest rate sensitivity on the commercial side of things than with residential. In America, this is another reason why I think America is under less pressure. I'm not saying housing prices aren't going to fall. They are falling. It depends on the market, of course. But we're lucky. We've got mostly 30-year mortgages. Most countries don't have that, and you certainly don't have that in the commercial lending area. So this dramatic increase in interest rates, which has been one of the most extreme since the early 80s under Volcker, I mean, it's just it's a stiletto right at the throat, at the jugular of the commercial real estate industry. So I got to believe there's a lot of people at some of these big REITs that are office and commercial REITs that are, they're not having a good day today. And especially this idea that the Fed looks like they're going to go higher yet.
So you don't agree with the old adage that real estate goes up forever?
Well, I've been around long enough to know that there are times it goes down. It tends to move more slowly than the stock market, the financial markets. So it's more of these kind of long, slow sine waves, but it does go down. I mean, 0809 was disastrous for real estate. I don't think it's going to be that bad again, although I do think office buildings are going to be maybe even worse than they were at that time.
The Case-Shiller Home Price Index, this is more on the residential side, but the Case-Shiller Home Price Index has been rolling over. Although on a year-to-year percentage change basis, it's still positive because the price grew so much last year. Where do you sit in terms of the direction of housing? Not commercial real estate, but residential real estate.
Much less worried about residential real estate than I was in 08. In fact, I started writing my newsletter for the first time in 2005, which at that time was called the Evergreen Virtual Advisor, EVA. And I really ramped that up into 06, 07, doing all I could to call attention to that tremendous bubble in housing and mortgages. That was the whole genesis of The Big Short. But this time, and one of the big differences now versus then is there was tremendous overbuilding of homes, whereas I think you can make a case today that when it comes to single family, there's actually a deficit, a supply deficit. Now, the problem is affordability stinks. And I think the reason home sales have kind of hung in there is you've had some of the more affluent buyers that have been able to step up, and interest rates have come down somewhat, for sure. That's helped. But still, affordability is awful. And I think you can only get by with that so long. So you've got kind of this weird tug of war between limited supply and terrible affordability. But back then you had bad affordability and a tremendous glut of new homes. So that's why it was so bad. Now, where the issue is with multifamily. So while there wasn't overbuilding of single family, there has been overbuilding of multifamily, particularly at the high end. So and actually apartment prices, guess what, from the peak are now down 21%, almost as bad as office buildings.
Okay, so let me make you a statement. It's not necessarily my opinion, but it's just a statement. And please evaluate it, agree, disagree, challenge it if you like. The real estate markets overall are in the biggest bubble territory, probably even in all of history. And the Federal Reserve has just popped this bubble with its actions today, and perhaps with more rate hikes down the line if they were to pursue that policy. And so this lag effect is going to be seen in the real estate market a few months from now when the Fed's actions will crash the markets.
Well, yeah, crash is maybe a strong word, but I think that when you see like office buildings down 25% over year, that's kind of a crash scenario. So I think it's not unreasonable what you just said. And I think what's a little bit terrifying is that there's no relief in sight. I mean, it's very unusual to have the Fed hiking rates into an inverted yield curve, into a banking crisis, into an escalating real estate debacle, and into an earnings recession. I mean, this is not the Jay Powell that we knew back in 2018, who did the famous Powell pivot when there was some dislocations just in the stock market. So he's really on a mission. And of course, what's changed is that we've still got this sticky inflation. The inflation is transitory narrative that the central bank sold the world on in 2021 was really dangerous. It was wrong. I don't think they did it intentionally, but they were just, who would have thought? I mean, we're 2 years later and we've still got these inflation readings that are, 5, 6, 7%. So that's his main mission. He's going to keep doing that. And what's interesting is with as much asset deflation that has gone on so far, consumer inflation has stayed very stubborn.
Speaking of data, you sent me these interesting charts. These ones I'm about to quote, courtesy of Harvard Analytics and Rosenberg Research. So the first one shows a VIX index, which measures the level of volatility in the equity markets, and then the MOVE index, which measures the level of volatility in the bond markets. And you're showing me this divergence, which traditionally has not happened. Tell us about whether or not this divergence is significant in any way.
Well, I think it is. I can't find a time when they diverged like this in the past. And so the move is not nearly as well known as the VIX. So, pretty much everybody listening to this knows the VIX is the volatility index for the stock market. The move is, I think it was Harley Bassman that created it. It's the VIX for the bond market. And typically when the move index is very high, so is the VIX, which means a lot of stress, a lot of almost kind of panic conditions. And actually the move index recently went to an all-time high. While the VIX went up, but not a lot, well, now the VIX is down into the no worry zone, whereas the move index is still elevated. And the reason that may matter is that there is another old saying on Wall Street that the bond market is smarter than the stock market, of which I think there's a lot of truth to that. So that's another reason to be concerned, because the bond market's sending a very different signal than is the stock market.
And what is this signal?
That there's problems, that there's stress, that there's a likelihood of a recession. Part of the reason the move has moved as much as it has is because short and long-term rates, but especially the longer rates, have come down quite a bit. We talked about that with mortgages. I mean, the mortgage rate was over 7. It's now down around 6. That's a pretty big decline. And you say, well, that's a good thing, right? Well, it is and it isn't. I mean, it's good for home buyers, but it is indicating that there is there's a suspicion that we are going to have a recession relatively soon in the bond market, which is how you get inverted yield curves, right? The long rates come down, the short rates stay up, which is basically what's happened lately. What's really interesting, if you look at the super short part of the Treasury curve, where you look at one month T-bills, which it could have changed a little bit, but they were about 3.5%, whereas the 3-month were 5%. So ironically, there you have a very steep yield curve, while the rest of the yield curve is inverted, and it's the most inverted it's been since the early 80s, which is another reason this Fed tightening is so odd. I mean, that's a classic 4-alarm fire signal when you have that degree of an inverted yield curve, and it's lasted for a very long time. So it's the bond market's telling us something is seriously amiss, and the stock market, for the most part, if you're not in regional banks or maybe lately oil companies, you feel like everything's great.
What does this mean for asset prices and perhaps asset price readjustment once this recession does eventually hit?
Well, typically in a recession, the stock market goes down 35%. And so far, what are we down? 15, something like that. Maybe not even that much, actually low teens right now from 2020, the end of 2021. So it's barely a correction, given the rally that's occurred. So that would indicate that if my concerns and the bond market's concerns about a recession are valid, the stock market's got a lot more downside to come, and it can happen really quickly. And as I said earlier, this is the time of the year when bad things tend to happen. The sell in May, go away, where a lot of the big sell-offs happen, and they tend to hit a crescendo in October, which often is a great buying opportunity. And I wouldn't be surprised if that's the case this time too.
You know more about economic history than I do. I'm just curious, sidetracking. Where did that adage come from? Sell in May and go away. Where do people go? Vacation? They go like.
I think it goes back to the 20s. I mean, I can't tell you, when it started, but it's been around a really long period of time. I have heard that as a theory about why that's the case is that the, kind of the power brokers go on vacation in the summer, and so the markets become very illiquid. You got kind of the junior people manning the ship. And then if you get big moves, they don't really have the authority to step in and do the buying. I don't know if that's right or not. I just
certainly if you're in Australia, it's winter time, so you don't have anywhere warm to go. Unless you stay in the office and trade, I guess. Okay, a couple more points I want to cover. You were talking to me offline about the de-dollarization trend, and certainly we've seen headlines about this. Some headlines more sensational than others, and I think it's coincided with the DXY kind of weakening over the last few months. People are concerned about a dollar collapse. Is the dollar collapsing?
No, I think that it's just working off what was a tremendously overbought condition that happened during the big dollar rally last year. What one of your competitors called, I think it's Michael Cow, the wrecking ball dollar scenario that played out for so much of 2022. It really ended in October or close to that, which is about when the stock market started rallying. So My belief is we're going to get a counter trend rally in the dollar, which will be another downward pressure on the stock market. And I do think that this de-dollarization is exaggerated in some ways, though I think it's going to continue to happen. You're going to see more trading among different blocks of countries with their own currencies and leaving the dollar out of it. But the dollars, if you look at the percentage of trades that occur in dollars globally, it's staying very constant. What's not so constant is treasuries held by foreign central banks. So, there's the dollars in currency, and then there's dollars in treasuries. And of course, there's a lot more treasuries out there than there are dollars. So that's, to me, the more alarming aspect, is where you're seeing this divestment of U.S. treasuries by central banks, foreign central banks. And what are they buying? They're buying gold. They're buying gold at the fastest clip they have in decades. So that's another thing that's going to, I think, create this fiscal funding crisis for the second half of the year. If you don't have the foreign central banks in there, you got the Fed selling instead of buying. How are banks going to step up and buy a lot of longer term treasuries when they've already had their fingers cut off and toes with their duration risks in their portfolios? At the short end, it'll be a breeze. And I do think at some point the Fed will try to do an Operation Twist where it will sell T-bills to buy longer bonds to try to support that long end of the bond market. But I think that long end of the bond market is going to have some real serious indigestion.
Okay, I just want to touch on the point you brought up real quick, which is central bank buying of gold. According to data from the World Gold Council, this came out 2 months ago, and 3 months ago in February, central banks added 1,136 tons of gold in 2022, by far the most of any year on record going back to 1950. Can you comment on why you think this accumulation happened in 2022?
Well, I don't think they trust treasuries anymore. And do you blame them? I mean, the way that the U.S. government's running its fiscal policy, it's like these things are, when I first started in the business, bonds were known as certificates of confiscation because they'd lost money for people for decades. And I think we're going back into that period where long-term bonds, and particularly treasuries, are considered to be certificates of confiscation by anyone paying attention. I mean, if you're getting a 3.5% yield on a 10-year treasury note, and the Fed is going to have one heck of a time getting inflation down to around 3%, that's not very good. And then if you get these periodic spikes in inflation where it goes to 6, 7, 8%, I mean, that's what I grew up with back in the 1960s and 70s. I remember that era. That's how the U.S. deleveraged after World War II, is it kept interest rates below the inflation rate for decades. Now, there were a few times where that wasn't the case, but for the most part, from 1945 to 1980, 81, that's how it was. And that's how we got our debt down from about 125% of GDP to 25% of GDP in 1981, which is why Volcker was able to take the prime rate to 20%. Now, you try to raise interest rates much more than the Fed's already done with how much debt's out there, it gets ugly real fast. I think you have a chart coming up of how much the government is spending already on interest, and it's shocking. And it's also shocking that the government's running 6 to 7% deficits when you've got unemployment at 3.5%. That's never happened before.
Can we just comment on that? People were telling me that the Treasury can't afford interest rates above 5%, but that's on new Treasuries issued, right? It doesn't apply to debt they already own. I mean, you're not going to... Am I missing something here? Because
you're not missing something, but the Treasury missed something. The Treasury missed an unbelievable opportunity to term out its debt. I mean, extend maturities. So back, if we go to the summer of 2020, the 10-year Treasury yield was 0.5%. They could have sold, and there was enormous demand for Treasury paper. They could have extended maturities, but what they've done is they've kept their maturity lengths very short. So it's something like, I had this number in my mind here real quick, but it's about a third of the Treasury debt is going to come due over the next year, and something like 40 to 50% over the next couple of years. Now, I could be off a little bit, but that's essentially correct. So and then the other issue is what we talked about with the Fed. So you've got $4.5 trillion with the Fed where that interest rate has gone from basically 0 up to 5%. And so that's $200 billion of debt service. So you're going to be the government's going to be paying over $1 trillion in interest alone very soon.
How are they going to finance this debt repayment?
Well, that's the thing that I think people are just absolutely missing. I don't know if you saw the Druckenmiller interview, the guy that was George Soros's star. that made him a billionaire, when they bet against the Bank of England in the early 90s. But he just gave a great interview where he was all over this theme, saying it just isn't doable. And he made the point that I've made in a lot of my writings and speaking, is that if you look at, it's not just the 30 trillion of on-balance debt, it's all the entitlements. And as he points out, it's about a $200 trillion number all in. And you can't say that those entitlements are down the road anymore, because old folks like me are now cashing in their entitlements. And it's going to get more intense for the next, through the balance of this decade. Now, you probably have heard me say this, that I'm bullish on the 2030s, because I think this decade, once we get through all the pain and suffering that's looking at us for this decade, once so many of the boomers die off, those entitlements are going to go way, way down. So the U.S. will bounce back, but we've got some tough years ahead of us. And that's exactly what Druckenmiller is warning the world about. And yet the stock market's completely oblivious.
How do you think fiscal and monetary policies will affect inflation for the rest of the year?
Well, I think it's going to be a tug of war. And it actually is a good point that, from a fiscal standpoint, you could say the government, because deficits are rapidly rising once again. So if you don't know this, in the first 6 months, the deficit was 1.1 trillion. So we're on track for a $2 trillion deficit for the full year. So that's stimulative, right? When the federal government runs big deficits, that's a form of stimulus. Now, the Fed's going the other way, of course. So you've got that tug of war going on. Now, part of the reason why it's a maybe not as stimulative as it looks is that the reason the deficit is blowing out is that revenues are falling. So tax revenues are actually declining. And that's very different than we saw in 2021 and 22 when revenues exploded to the upside. So revenues are going down and spending's going up. Spending rose at about a 14% clip. So that's why the deficit is worsening. You could still say it's stimulative, but it also creates this potential of an absolute train wreck in the bond market if there aren't enough buyers to show up. And there just isn't that much balance sheet capacity out there in the world to support that kind of Treasury deficit financing. And again, some of this is being hidden because they're deferring the Treasury auctions that would normally occur. So the second half has the potential to be really messy.
So Janet Yellen's warning that the U.S. may not be able to meet its debt obligations by June 1st. Is that a realistic scenario or not?
I think she's probably being a bit negative to try to spur the Republicans to go along. But I think they're going to make a strong argument to the administration that when President Biden was Senator Biden, he opposed the debt ceiling increase 10 different times, and it was all based upon fiscal soundness. And at that time, we look, compared to today, we look like Switzerland. It wasn't all that long ago that Alan Greenspan was worried we were not going to have any debt market by 2010. He really made a speech on this in 2001, where he worried that we were going to pay off all our debt and there would be no Treasury bond market by 2010. Another not so great forecast by a Fed head, but we don't have to go there.
Okay, so finally, Warren Buffett at his 2021 Berkshire Hathaway meeting, I'll show a video clip for the audience.
Look at that list for a minute or two if you want to, and then make an estimate, make your own guess. How many of those companies are going to be on the list 30 years from now? Here they are, these powerhouses. And how many would you guess are going to be on the list? Well, it's not going to be all 20. It may not even be all 20 today or tomorrow. This was March 31st. But what would you guess? And think about that yourself. Would you put on 5, 8? Well, whatever it would be. Slide 2, which goes back a little more than 30 years, and look at the top 20 from 1989. And if you look at the top 20 from 1989, there's two things that should grab your interest. None of the 20 from 30 years ago are on the present list. None. Zero.
The largest companies in the world today, by market cap: Apple, Microsoft, Saudi Aramco, Alphabet, Google, Amazon, Berkshire Hathaway, NVIDIA, Meta, Tesla, and LVMH. How many of these companies do you think will stay on this list 30 years from now?
Well, historically, not many. And it's actually interesting that because that list that you were talking about, he gave in 2021 of the top 20 companies in 2021. And since then, 3 are already off because Alibaba was one of them. MasterCard was one. What was the other one that's come off of it? It's this Co-CIO. I know it's a Chinese company. I don't even know how to pronounce it, but it's fallen off the list as well. So in just 2 years, you've already seen 3 come off. And when you look back to that list he showed in 1989, that's pretty fascinating because of those 20, 17 were Japanese, which really speaks to the Japanese bubble. Really, that was a shocking. That might have been, well, no, I still think 2021 took the cake, but that Japanese stock market and real estate bubble, because that's when you may recall that the land under the Imperial Palace in Tokyo was supposedly worth more than all the real estate in California. So it was a twin massive stock and real estate bubble that popped. And so now today, there's not a single Japanese company on that top 20 list, and that was the case in 2021. Now, what's interesting, what wasn't on the list in 21, but is back on, which was also on the list in 1989, is Exxon. So Exxon was on in 1989. If you run that list today, which I just did, it's on again. So that tells you something, that first of all, we need energy, and that these energy companies have some very enduring competitive advantages, or as Buffett likes to say, moats. He loves companies with moats. He doesn't own Exxon, I don't believe. I know he owns Chevron, quite a bit of Chevron. He owns a lot of Occidental Petroleum. So that's kind of interesting. But also, if you went back to 1999 and looked at the list, it was almost all tech. And a lot of those companies then, by 2009, I think there was only one or two tech stocks still on in 2009. There was a very heavy weighting towards energy by 2009, ironically. And then they got all flushed off by 2021 and even before that. So I think the basic point is you go through a lot of changes in a decade, and most people, unfortunately, are very backward looking. And so they expect the winners of today and in recent years to continue. And I think the point that he's making is there's this constant realignment that's going on. And if you get wedded to today's winners, and he owns some, I think I know Apple's his biggest position, which is number one. So I think when you see these companies that are way up there, you got to be careful because it's hard to stay on top.
Do you think that tech today, big tech, I'm talking about big tech, is the utilities of our generation in the sense that they're as indispensable as an ExxonMobil?
Yes, I do. I think that these guys have such a powerful network effect, but you don't know what are the regulators going to do. Will the regulators, go after them at some point to break them up? Will it become like they did to AT&T or really hamstring them like they did with IBM? But I think there is more resilience there with the companies like Microsoft, Apple, and Google, and of course you got AI, which the more I see about AI, the more I think this is going to be a huge deal. And companies like Google and Microsoft and maybe Meta too, are quite well positioned there. So, I have a feeling some of those in 10 years, some of those mega cap tech names will still be on the top list, but you may not make much money. And that was the other thing that was interesting about his list is I think in 1989, the largest market cap company was 100 billion. You could correct me if I'm wrong, but somewhere in that area. And now it's 2 trillion. So you think about the inflation that's occurred in the valuation of these top companies, and it's just shocking. So when you have a $2 trillion market cap, it's tough to make money. You're going to get a 100% return over a decade. It's going to have to be a $4 trillion company. And I guess that can happen, but kind of long odds.
The upside to inflation is that if you're an investor, you get inflation in your asset value as well. But that's if you're a long-term buy and hold value investor. But anyway, David, I appreciate your thoughts. That was very thorough. Where can people find out more about your work? You're an author of several very fascinating books. You've got a Substack. Tell us about your Substack.
Right. So with Substack, we do a weekly newsletter, actually bi-weekly. The one on Monday, Making Hay Monday, is the one that most people like to read because it's got specific market comments and action items. But we also do a highlight reel on Friday. It's free. So there's absolutely no reason for somebody not to sign up for it. And you can go to Haymaker_Substack and easily subscribe. And I hope you do, because we're trying to grow that readership, and we're trying to help as many people as we can. And so, and then you're right, I wrote Bubble 3.0, which we published digitally on Substack in early 2022, because I wanted to be ahead of the implosion of Bubble 3.0. So thanks for pointing that out.
I'm curious as to when you're going to release Bubble 4.0, but maybe some years in line. We'll keep tabs. We'll keep tabs on that development. Yeah, we'll keep tabs on that. Thank you very much. And I'll put the links down in the description below. Please check out Bubble 3.0. And bubble3.substack.com is the website. David, I appreciate your time today. Thank you for coming on the show.
Thank you, David. Always a pleasure.
And thank you for watching David Squared. Please stay tuned and subscribe.